Welcome, everyone. It's Peter Culver from Freedom Family Office. And on behalf of all of us at Freedom Family Office, it's our pleasure to welcome you to an annual staple here, which is our year-end review of important investment, economic, and planning tips for you. Pleased to be joined today by Kyle Cain, our CIO, and our latest advisor, Stacy Culotta. A little bit more by way of introduction from them in a minute. I do want to alert you that Kyle has recently written a book, Smart Money Moves, essentially how to take all the stats and charts he's going to show you today and use those to turn your portfolio into a bigger portfolio. So you can, scan the QR code here or write to us. It's not an overly technical book, but filled with lots of good practical suggestions. So again, our two speakers today are Kyle Cain and Stacy Culotta. And I thought just most people know Kyle, but a lot of them don't know Stacy. But just remind our listeners, Kyle and Stacy, a little bit about your background and your role here at Freedom Family Office. Kyle, let you
Sure.
start.
Yeah, sure. Thanks. I'm glad to be here. So I'm the Chief Investment Officer with Freedom. Been with Freedom about 6 years or so now. Been managing money for close to 20. Certified financial planner, certified investment management analyst, accredited portfolio management advisor. So just here as the investment expert to kind of give you an overview on what we're seeing out there and potentially outlook on what to look for going into next year.
And Stacy, I'll just say on behalf of Freedom, Stacy recently joined us 4 months ago. Is that about right? 3, 4 months
Yeah.
ago.
Yep.
And I'll let you tell a little bit about your background, but she's in a very short time become a super valuable colleague to have on the team. And she's eager to help all of you with any investment and planning issues you might have. So Stacy, tell our audience a little bit about yourself.
Sure. I appreciate that. So my name is Stacy Culotta. I've been in the business for 23 years, which sounds crazy. Um, but I recently came from other firms that are big firms that you would know of. And I'm really excited to be at Freedom Family in order to be, an additional team member. I do have a master's in financial planning. I'm a total nerd in that way. I also have a graduate certificate in financial therapy, and I'm also a CFP. So I think it rounds us all out with all of our team members to be able to give you the best service.
So I guess we could say we're going to combine today the science and the psychology of investing
Right.
planning, right? So thank
Right.
you. So if we turn, 2025, and hopefully we'll talk a little bit about 26, but a little bit of an odd year. I think starting out the year, nobody really knew what to expect or was afraid what to expect from Trump. And the markets were skittish in the beginning of the year. And then with his tariff announcements, Independence Day, markets took kind of a swoon. But really, since, you know, February, March, they've come back pretty strong. So we'll have Kyle help us understand why that is. Can it continue? In light of both of those things, what things might you do with your portfolio, both between now and the end of the year and maybe looking into 2026. So I'll turn it over to Kyle, who can give us that investment perspective on the past and the future.
Thanks, Peter. Yeah, you're right. It's definitely been an interesting year, to say the least. You want to go ahead and put the first slide on. So just to give you this little perspective, right? This is a longer term chart, but year to date, markets are up about 15%, which if kind of going into it, someone would have said, all right, we're going to have tariffs about 5 times higher than what we started the year with. That employment has only grown about 0.5% over the past year, which has only happened, during recessionary periods. I don't think many people would think the markets would be up 15%, but certainly after Liberation Day, the concerns of what the some of those ridiculously 20 to 50% tariff rates, things have started to cool down. And ultimately, which we're talking about here in the slide, is like what drives the markets. And, we'll circle back to its earnings. Earnings drive, at the end of the day, that's what really matters. But it's kind of a rhetoric of, I won't say like the taco trade, like Trump always backs down or chickens out, right? And that it is going to be a little bit more rational negotiations than just the blanket what we saw on Liberation Day, but also right the aspect that we're going to get Fed cuts and that we're going to potentially see some deregulation, and then certainly the tax bill that was passed are going to help significantly, with the capex and R&D deductions, et cetera. So overall, the markets have continued to grind higher, and if you look, it's not just been a US story for the first time in a while. I don't have the chart pulled up here, but international markets are even up better. They're about 30%. Why? Mainly because the dollar dropped, et cetera. We can get into that. Gold is up 65% today. It's not having a good day, but and what have been the sectors that have continued to do well the most? It's been still the AI trade, right? So I have this up here showing sort of the Magnificent Seven performance, back since 2020, really started to take off kind of in the end of 2022 when ChatGPT came out, right? And that sort of was a game changer as far as all of at least what we call the hyperscalers, these magnificent performers, really ramping up, trying to be the leader in it. So, I guess I also put this slide up here to show, one, there are risks out there, and we'll kind of talk about those risks, but the job market, tariffs. We've seen some credit defaults here recently in some of the bank earnings calls. But I think one of the biggest ones, and what I'm going to talk about first, is the AI bubble, right? And everyone's kind of hearing that as being the thing that you turn on the news, what you hear constantly. And I'll say, first and foremost, is there a bubble? And yes, there is. I'll say the answer is yes and no. Certain areas of the market are definitely frothy, right? But I will ultimately say, no, we're not done yet, right? If you look at sort of like OpenAI, it's been in the news pretty much for all of these deals lately. Again, is the one that first came out, the ChatGPT. It's valued at like $500 billion. However, it has like $13 billion in revenues, right? It's committed almost like $1 trillion in investments when it, again, only makes $13 billion. How's it going to fund, $1 trillion in investment? So certainly there is some speculative nature to it, but this is different than the dot-com bubble dramatically for several different reasons. Ultimately, again, it goes back by earnings, and majority of the crazy amount of money that's being spent on CapEx, which is, absurd, it's coming from free cash flow. Amazon, Apple, they're really just doing it from free cash flow versus, taking on a lot of debt and some of the other nuanced things they did back in the tech bubble. There are a few things like Oracle, for one, is starting to borrow. We're seeing some, we call these circular deals, right? Where it's really just the top names keep paying each other for different types of things, which can overinflate valuations. But at the end of the day, I can go into more of the nuances. It doesn't look like it's anywhere close to stopping. In fact, I think if anything, some of these more creative CoreWeaves and Oracles that are starting to borrow to produce this only means that the spending system keep ramping up. So I still think we're in early innings, and that could continue. Go ahead and go to the next slide. So, again, that has led to elevated valuations. This kind of slide on the left, far left, just shows sort of the US, we're almost about 23 times earnings, which is about the highest, it's kind of at the top of that range, not quite as high as it was in 2021, but it's expensive. You look at the rest of the world, not quite as expensive as us. But I want to say, and I'm sure you've all heard this, but it's for good reason, right? The overall makeup of our markets compared to where they used to be, the return on equity on these firms are, insane. It's like 80 something percent on the Mag 7, the return on equity. Their margins does warrant a significantly higher PE ratio. And then the makeup just of the S&P 500 is a lot different than it was 20 years ago. So just the overall aspect, valuations is not a metric you really want to play as far as a short-term indicator. You don't want to say like hey, things are over expensive, we're going to have a pullback, because it can go on for a long time, these elevated. And I think we're in a secular market where we're going to see this be more of the norm for the long term than not. Then the last thing I want to say, sort of about the bubble concept here and valuations being stretched is like, certainly, again, when I went back to like the yes and no, could there be so much money being spent that eventually the revenues aren't there in the long run? Yes. Some companies are going to get hurt. Some companies are going to win, just like even the tech bubble, in the internet bubble. Ultimately, it was a transformative, the internet was a transformative thing in society, but plenty of companies thrive. Some companies that you never heard of thrive, and some of the big companies, Cisco, et cetera, just lost 80% of the value. Again, I think we're a little bit different now, but there's still going to be similar scenarios where some companies, aren't going to be here. Other ones are going to do well. So hence diversification. I don't think it's done. You still can play the AI, but balance it out, balance it out a little bit. The last point I wanted to make about the bubble was that too, one reason not to worry about it quite yet is every time in history a bubble has popped, it's been because of rising interest rates. And we're in an environment, it's the Fed kind of taking the punch bowl away that ultimately bursts it. We're in a period right now where we know the Fed's going to continue cutting rates. So we're just continue to have easy money. And also investor sentiment isn't extremely high. So like I said, it's still something you need to watch. You don't just throw good money after bad. But I think a lot of the froth is in the private markets more than the public markets. All right,
I'll
next
also
slide.
say, if I could just jump in really quick, a lot of my clients will tell me, oh, I was there for 2008. I was there for, the terrible things, the bubble, and I don't want that to happen again. And what we need to understand is we're not in the same generation at all in the stock market. Everything's different. So I encourage my clients not to do the compare game. That's part of the, behavioral science is try not to compare this time with times in the past because it's just different.
Yep. And then even in the 2000, 2008, right? Like, yes, there can be some extended periods where things don't work out well, but you would have made a lot of money if you had invested in 2000 and you're, still holding some of those dollars today, or 2008 and you're still holding those dollars today. You still would have made significant amount of money in the markets. All right, go ahead. Next slide. All right. So the other, big concern I'm sure everyone's kind of heard about is the, the employment market. And is the economy as strong as we, expect? And if you remember sort of Q1 of this year, GDP was actually negative for the first quarter. But again, if you look at what the reason, it was because of tariffs, right? And we imported tons of, which hurts, imports are a negative to GDP. And we imported a bunch before tariffs were in effect. So that, skewed it. You go back to Q2 now that things settled down and some of those imports cooled down, was what 3.8% GDP in the second quarter. In this third quarter, we've been running, the estimates that it should come in, close to that closer to 4% is what the nowcasting says. So the economy is holding up. Even though, like I said, job creation has been extremely slow. We had our first negative print. Right now, we all know that we didn't get the most recent payroll data because of the government shutdown. So we have to rely off some alternative data. But ultimately, the point is, it's certainly something to watch. I'm not saying that we're completely out of the woods. Often employment is a circular, self-reinforcing type thing, right? The more that individuals are less employed and more laid off, then they spend less, which then makes companies, lay off more. Those things can happen. However, here's kind of the silver lining is that it's not, even though it's been less growth, Reason being, there's been less immigration, right? So the unemployment rate hasn't gone up. The um, you know, the end of the day, still the unemployment rate is extremely low compared to history, and the average income has significantly, it's like 4.8% over the past year has been the average income gain versus only about 2.7 in inflation over the past year. So individuals actually still have more purchasing power today than they did. So they are able to continue to spend. And then, like I said, we've had great GDP growth over the past year, even though we barely created any new jobs. So that means productivity is significantly higher than we previously expected. And I don't think we can say right now that AI has been a big part of that, but it could be, right? It could have a significant trend going forward that AI can help supplement, even with slow job growth, productivity and money being made in the stock market and earnings continue to grow. Like I said, we're not out of the woods completely yet on how this is going to fold. But I think a lot of economists believe that once some of this tariff, continues, all the uncertainty sorts of move past, right? A lot of people haven't been hiring because of so much uncertainty. Once we start to get a little more certainty with how tariffs are going to look going forward, and then we get more implementation from the tax bill, impacting balance sheets, and then some deregulation coming in that a lot of, and lower rates, the combination of those, a lot of economists believe that we'll start to see hiring pick back up again in 2026. Next slide. So let's talk about obviously tariffs, policy, inflation. Inflation has been stuck, at the 2.5% to 3% range for quite a while. I think a lot of individuals thought it would have been worse actually than it has been so far. You hear that out of the administration, of course. And I would say the point is, so far we haven't seen a whole lot of it through tariffs. I won't go through all the data points, but ultimately, right, the effective tariff rate currently is about 16%, but we're only seeing that it's actually being implemented around 10%. Why? Because there's mitigation strategies. They imported and stocked up on inventory, beforehand. Those things are starting to get depleted, and a lot of firms have been trying to maintain, their market share, so they've been eating some of it. Overall, we haven't seen, like I talked about, the earnings margin. The earnings margin profit margin has been good so far, but it's actually made up from some of those really big mega cap stocks. If you take out kind of the Mag 7, the bottom ones have had a little bit of earnings margin hits, and that'll likely ramp up a little bit more in the second half into 2016, where we're going to start to see the inflation come through. And again, now we're in a point of, can payroll or can and wages stay compete with the inflation, or is there going to be a squeeze on the consumer and they start spending a little less or be able to afford less? But I think we all know, which kind of go ahead to the next slide here, that so far spending, even with the 3% inflation, has held up. And a lot of this has to do with what they call this K-shaped economy, right? That the lower end consumer has been squeezed, inflation, housing affordability has been rough, but the top 10% or so of earners make up about 50% of spending currently, which is about the highest in history. But their wealth effect, inflation, higher interest rates has actually been good on the wealthy. And I think I have a slide in here, which we'll go to in a minute, that shows that wealth effect. And that's been able to keep personal consumption still pretty steady. And I think that is likely to continue the way the makeup is as interest rates come down. Again, there's going to be some pros and cons from tariff hit, some cons from the tariffs, some pros from the tax bill. I think the one of the themes you'll see as I go through all these slides is a lot of these things counteract each other. So it's, we're still kind of on that status quo. Even all the bad things you hear about, there are some good things offsetting it, et cetera. So, spending has continued to hold up for now. Go ahead, next slide. Yeah, this is another thing, just kind of emphasizing that point of, the top quintiles, supporting most of the spending, and you see that luxury spending still good, and then the lowers kind of, spending down, like Dollar Tree and Dollar General have actually done pretty well this year. Move to the next slide. Yep, here's just, goes in a little bit more about that wealth effect and how much wealth has actually been, trillions and trillions of dollars added that they feel comfortable continuing the spending. The next slide, I think, is a good one here to show a little bit more detail, right, of my point of how overall, even though you probably have heard things throughout the year that the consumers hurt and that student debt, now they have to start paying back their loans, and that's going to squeeze spending. And there's been so much concern about the consumer is tapped out with inflation that they can't handle anymore. And I think ultimately, this goes to show we have counteracting sort of, impact that next year, once we have the tax bill and we start to get tax refunds, that's going to be a big surge of surplus to most consumers to be able to continue. I'm not a big into consumer discretionary stocks just because of the risk and tariffs, but I've heard a few analysts suspecting that consumer discretionary should have a good year next year because they think it's actually going to be a bigger splurge in consumer spending than most is expected, because they also believe that employment's going to turn around. All right, next slide. All right, so last, a couple of things I want to leave with is, we talked about, deregulation and the job market. Another big catalyst for why the markets are continuing higher is lower rates, right? We finally got our first Fed's rate cut in September. Pretty much, baked in that later this month, we're going to get our next rate cut. The Fed produces what's called a dot plot, right? Where they, everyone on the board sort of indicates how many cuts they think is going to happen based on what they think is going to happen as far as economic data over the next year or so. So the dot plot showed 3 this year, including the one we had, 1 more next year, one more the year after that. What ultimately, it's hard to know where and why are they cutting, even though inflation is high. I guess the main point there is that inflation is elevated, but the main thought is, one, tariffs should be a one-time adjustment. It may gradually happen over the next year, and we may see inflation go up to even as high as 4% at some point early next year, but then it should come back down as long as expectations for inflation remained anchored. So they see the two sides of their dual mandate, employment, inflation. Inflation, if it should, the outlook going out in the future should be a one-time adjustment and then come back down. They need to start focusing on the other side of the mandate, knowing that at 4 and 4.25, where they currently are, is what they would consider restrictive. No one knows where the neutral rate is. The neutral rate is where they talk about where it's not speeding up the economy or not slowing the economy. Their estimates right now are about 3%. Again, no one really knows, but they just all right, we might as well start the adjustment to get down closer to neutral so that we're no longer at least slowing down the economy. We're still not speeding it up, is their thought. So it's not like they're cutting rates to speed up the economy. They're doing it just to have it have less of a drag, and so it doesn't hurt employment as much. So ultimately, right, that is a benefit for. Well, here's what I'll say. It's actually not as everyone just loves lower rates, right? It's good for lots of different things. It's good for equity valuation. Stock market does well because it's based on a discounted cash flow. But technically, there's been some analysis done that how much cash is out there and what individuals make off of the cash with the higher interest rates versus most debt being locked in at the low mortgage rates and not that much debt is revolving. You're actually, getting a little less income than you are. But I digress. That doesn't really matter. What matters more is the environment for businesses and mortgages, right? And that is my next point, is that, the 10-year drives mortgages. We know the housing market's been in, a recessionary environment and basically been frozen for several years now. I think go ahead to the next slide. This shows the 10-year treasury, and that's more what mortgage rates are based off of. We're finally now, today we're at about 3.96. It doesn't necessarily follow the Fed funds rate exactly, but the trends usually do. If the Fed's cutting, the longer end could move down further. Obviously, you probably have heard things about, our deficit, and there's been issues in France and Japan. And could there be a scenario where the Fed cuts rates, which actually happened last year back in September when the Fed cut rates, the 10-year rose? That could happen. I think ultimately will probably stay, that the short end will come down. The 10-year will sort of stay around this 4.2% range. It could, if it goes down to 3.6 or so, again, that's just a benefit for bondholders, a benefit for society, because mortgage rates will go down. There's more to mortgage rates, which I don't go into. So there is a possibility for mortgage rates, which are about 6.3-ish%. Even if the 10-year stays at 4, it could, and doesn't go lower, the mortgage rate could move because it's actually a higher spread than historically speaking. And again, there's things they can do with quantitative easing, et cetera, to move mortgage rates lower. So, my point being is that would be a huge benefit if we get mortgage rates down to spur the next part of the economic momentum. So we can bypass this. So last, I guess, kind of to sum it up here a little bit, right? There's plenty of good things. Consumers still spending well. Earnings have been great. Again, that's where I go back to as the main driver. We've just had 3 quarters in a row of double-digit earnings growth for Q3, which we just started. Earnings season, it's starting off great. The expectation was for about 8% earnings growth for Q3, and usually we beat it by about 5%. So this should be about the 4th quarter in a row that we have double-digit earnings growth. Expectations for next 2 years is 10 plus earnings over the next 2 years. So when you sort of put into consideration of the tax bill, lower rates, deregulation, CapEx on AI spending, which I don't think is done yet. And then, to be honest, I think that it's going to broaden out. Like part of the tariffs was to get manufacturing here in the U.S., and that really hasn't happened quite yet. But why? Mainly it's because of the uncertainty. Certainly, policies do align with the tax bill and with tariffs do incentivize more firms to start to build here. So I think the combination of those should continue to allow the equity markets to continue grinding higher. Of course, there's going to be little spits of volatility, concerns about the AI. I would be a buyer. So recommendation is, continue to be a buyer on dips. Obviously keep an eye out for risk. Areas I like is, again, just don't play the AI trade too concentrated. Don't just put all your money in NVIDIA. Don't do, kind of spread it around between semiconductors, software. There's other aspects that are going to benefit from that. Industrials, financials should do well from, deregulation and a steeper yield curve. The healthcares, some of the points that so you want to kind of barbell a little bit with the pure more AI plays. And then there are other pockets that, in case those do get overvalued and have this safe, like have some more defensive areas as well. Like healthcare is one where it's performed extremely poorly with concerns with the administration. I think now some of the fog has been lifted with, that Pfizer and some of these firms have negotiated with the administration on drug pricing, and certainly AI is a good tailway, and there's the demand there. So healthcare outside of the U.S., again, that's why you should always say diversify. I still like the U.S. best, better than most of the world, but Japan, the new administration there should continue to support good governance and stocks and more stock buybacks, things like that to help their stock market. China, overall economically, there's concerns, but to be honest, their tech looks pretty attractive, whereas our tech is a lot more focused on just building. Their tech is a little bit more on doing it cost effectively and actually having more prudence, and they're cheaper. So I'm pretty optimistic on Chinese tech. On fixed income, like you said, a lot of the rate cuts have already been priced in on the shorter end on treasuries. So, your cash that you're sitting on and you've been used to earning 5% for the past couple of years, that's going to keep going down. So I recommend, sort of moving out. You don't necessarily want to go fully out to treasuries in the 10-year, just in case the 10-year does move back up. But that 5 to 7 year range, investment grade, high yield, you're not really earning too much of a spread over investment grade. And like I said, we saw a few cracks with a few bankruptcies last week. So I would, shy a little bit away from there. So mortgage-backed securities, investment grade corporates in the 5 to 7 space, diversify into some emerging market debt. I think, there's a few different areas that look pretty attractive. There's still risks on the horizon, but ultimately I'm bullish over the next year.
I just wanted to jump in. Over the last 23 years, I have a lot of clients who have the yeah buts. So when something is great, like NVIDIA or, Micron, people want to invest in it and they want to get that upside so bad because they see other people who are making a lot of money, they're concentrated. But then when the baseball hits the window and you only have one pane, meaning I only have NVIDIA because I want to ride it up, your whole window cracks, your whole window breaks. So this speaks to diversification in a huge way. We don't know what the next big thing will be. Markets are efficient. We can't time the market. So what Kyle was alluding to, not alluding to, but actually saying is diversification is the only way that you're not going to get pummeled if you only have concentrated risk. So I just think it's interesting to think back over the last 20 plus years and hear the yabbits. So don't have the yabbits.
And like the perfect example, like NVIDIA, it can continue to make tons and tons of money and do well, but based on its valuations, if it is the leader, but AMD and Broadcom, we've seen some deals pull back where, and then you have where a lot of companies are rather using their chips, more customized chips than NVIDIA's, and their technology advancements could make AMD catch up to NVIDIA at some point in time. So it still could be like, it's not a zero-sum game that they all make money, if they don't all make money, but NVIDIA's, growth rate could slow. And because it's such a high premium that even though it's making more money than last year, its price drops, right? And AMD catches up. And so there's, these environments that you could still be right on your analysis that NVIDIA is going to do well, but lose money in the stock. So, hence diversify, because there's always things that can happen. Correct.
So let's pivot for a few minutes from the investing side of it to the planning side of it. And I think we have 5 or 6 topics that Stacy's going to kind of walk through with us. So everybody thinks about charitable giving toward the end of the year, probably because they forgot about it in the first part of the year. And one thing that we've been recommending that a lot of our clients do is do their charitable giving through a donor advised fund, DAF. So Stacy, unpack for our listeners what a DAF is, how it works, and why it can be a very efficient way to make charitable contributions.
Thank you. Yes. So donor advised funds are a way to give to charity and have the control as to when you give it. Several years ago, we lost the privilege of deducting charitable donations unless it's a very large donation. So if you have a situation where you're very charitable and you want to have like a plan, like a 10-year plan. You want to invest in, let's say, SDU, San Diego University, and you want to gift them over the next 10 years $10,000 a year. If you bundle your gifts, $100,000, you now do qualify for a deduction. So what that is called is bundling. So when you invest money into your 501c3 charities, and you have a plan forever, to always be charitable, you really have the opportunity in a donor advised fund to overfund it and then have the decision every year on who gets that money. So let's say, you don't like SDU anymore, you don't like animal shelters, then you can switch gears. You can really give to any 501c3 that you would like. And we all know that over years, sometimes charities that we used to like, we don't necessarily like anymore. So it's a really good way to get a tax deduction in the year that you give it into the donor advised fund, and just plan for the amount that you're going to be giving to charity. It definitely helps with estate planning as well. So as soon as you put money into a donor advised fund, it comes out of your estate. So those that have estate tax problems, this is a huge strategy that we utilize, especially for those that are charitable.
So another important area at the end of the year is required minimum distributions from IRAs, retirement plans, things like that. So
Right.
let's unpack that a little bit, the rules and how they're calculated, and I suppose most importantly, what the consequences if you don't take your RMD.
Right. A lot of our clients have really large RMDs, required minimum distributions. Required minimum distributions were put in place because the government is greedy. Uncle Sam wants his money at some point, and he hasn't got any of the money since you put it in there because of tax deferral. So at some time, the government's going to say, I want that ordinary income tax. So at 73 at this point, it is projected to go up to 75. You must start taking distributions from any retirement account, 401ks, 403bs, SEPs, simple, you name it, IRAs, not Roth IRAs, and I'll get to that on the next bullet point. But you have to take out money. So if you don't take out the money, let's say you're 72 and you just turned 73 today and you forget about it. You don't even think about it next year, and your required minimum distribution was $200,000. Until last year, the government would have taken $100,000 as a penalty, 50% that you didn't distribute. Now it's 25%, but I don't know about you guys, but I don't want to give 25% of what I put into my retirement account just because I forgot to take the required minimum distribution. It's very impactful. I have had situations where a client didn't take their RMD and it was disastrous. It was a large sum of money. So you want to make sure you're with your advisor and ensuring that all of the required minimum distributions are taken. There's another little caveat there. With inherited IRAs, we used to have different rules about inherited IRAs. You could take the required minimum distributions over your lifetime, but years ago that has changed. So anybody who has an inherited IRA must have it depleted within 10 years. There are some caveats there, within 10 years. So you don't have to take it annually necessarily, but you have to have it depleted in the 10th year. So if you have large inherited IRAs, it is my recommendation that you don't wait until the end, because we know what tax rates are now, but we don't know what they're going to be in 10 years. Also considering the growth of that inherited IRA, it's hopefully going to be a lot larger than it is today. So just a systematic distribution each year is usually the answer, because we just don't know what the future holds.
And everyone on the call, be aware that here at Freedom, our custodian LPL Financial calculates your RMD for you, and it usually appears right on your statement. So if you've turned 73 years old in the last 12 months, that's an issue you want to focus on. So another interesting planning opportunity is what's called a Roth IRA conversion. And Stacy, maybe help our listeners remember what that is, how you do it, and when is a good time to do it.
Right. The Roth accounts are like the utopia of all accounts. You put in money after tax, so meaning that you don't get a tax deduction just in general for Roth accounts, but it grows tax-free and every distribution is tax-free. There are some caveats there as well. So what we do with clients who maybe they retired this year, they retired in May, they're used to making, $800,000. They only made, 400 now. This could be a good reason or good time to do Roth conversions. Maybe not those income rates, but let's say you make $200,000 a year. You only work 3 months out of the year. So this year, your income tax bracket will be much lower than you're used to. So what we suggest is to take money out of your IRA, which is pre-tax. You have to pay the tax on the distribution, but roll it into a Roth IRA, creating a larger bucket of tax-free income in the future so that you don't have to take all of your distributions from a very tax inefficient IRA or 401k. The tax-free growth in Roths it's a huge game changer. Some people have the taxable money, the non-taxable money, and they maybe the non-taxable money is such a small amount that it's not really worth even calling it a bucket, right? So we want to make sure that we manage your tax bracket in terms of recommending if you do a Roth conversion, because sometimes it doesn't make sense. But each year we want to evaluate whether or not this is the right thing for you. Is this strategy savings for you? Because we know what interest rates are now. We know what we're getting now, but we don't know what they are in the future. I would hate for 10 years from now to have you be in the 39% tax bracket because of RMDs when we could have planned over the last 10 years to minimize what your RMDs would be by Roth conversions.
So maybe two additional points about that. Traditionally, the analysis would be if I take the money out of my IRA and pay tax on it, and then put it into a Roth IRA and invest it tax-free, how many years does it take me to sort of get back to square one and then ultimately be ahead, a hurdle rate, for lack of a better term? Please be aware, if this topic interests you, in our sister company, Wealth Thrive, which specializes in some more powerful tax saving strategies, we have some strategies that could significantly reduce the tax you might pay on doing a Roth IRA conversion so that hurdle time period is either eliminated or dramatically shortened. And it could be almost like flicking a switch from going to an environment where if you do nothing and just start taking money out of your IRA, you're going to pay ordinary income tax. But if you can convert that ordinary IRA to a Roth IRA, it'll come out tax-free. So happy to help you with that. So retirement and savings contributions, they're slightly different rules for IRAs, for 401ks, and maybe, but they are usually time bound in the sense that the rule says you can contribute up to a certain amount every year. And so you don't want to miss those because you're missing the opportunity to get more money into a tax deferred environment. So guide our listeners a little bit about that, Stacy.
Sure. Compounding growth is nothing to scoff about. It's huge. So we want to make sure we're investing into our 401ks, IRAs, simple IRAs, SEP IRAs, because over time, a lot of our clients are entrepreneurs in their 30s and 40s. They have a long time until they retire. So putting money in tax-free or tax deferred is a huge roller coaster up, in terms of what your account will be in the end. So 401ks, for instance, you can actually, if you're under 50 years old, you can contribute $23,500 a year. If you're over 50, you get an extra 7,500 on top of that. So as you reach the age of 50, if you can, it would be so beneficial for you to do the catch-up provision every year. Each year, most years, that contribution limit does creep up a little bit. So you'll want to speak with your advisor about what your maximum contributions can be. But you have a huge opportunity to really stock away money for the future. Traditional IRAs and Roth IRAs have a much lower contribution rate. So if you don't have a 401k, you're not employed, but your spouse is employed, you as the spouse can open up a traditional IRA or even a Roth IRA. And the limit below 50 is $7,000. So,
Right.
yeah. So, and the catch up is only 1,000. But if that's the situation you're in, by all means, you should do that because, like I said, compounding growth over years, $8,000 a year, and a couple of years it'll probably be $9,000 a year. It really makes a difference in your overall plan and whether you're successful or not. SEP IRAs are interesting because I actually have my own SEP IRA. You can really sock away a lot of money. Actually, your employer will sock away a lot of money. It's 25% of your income or $70,000, whichever is lower, that you can put into your SEP IRA. So there's a lot of different vehicles in order to save for retirement. And it's not intuitive, right? All of the things that we've talked about today are complicated. And, what Kyle was talking about is not something that the average person wants to dig into. Same thing with, what can I contribute to my 401k? People don't want to do that. They want to have a trusted advisor to lift the burden from their shoulders and, have them have their back. So we want to make sure that you're contributing as much as possible to your retirement accounts so that in the future you have money to live off of.
And I'll just jump in real quick and say that, yeah, I mean, right, if anyone ever looked at one of those, mapped out projections of wealth or did some financial planning and saw that, or anyone who has a large taxable account can attest that, there is a significant tax drag from just having all your money in taxable accounts and capital gains and interest and dividends being hit. So obviously maximizing tax deferred or tax free, compounding is great. And you want to take advantage of that as much as you can. Beyond that, yeah, chances are you're going to have some extra, whether you already have or you're in the accumulation phase of building those taxable accounts as well. Make sure, which you don't do it, that you're doing it as tax efficiently as you can on that front, right? And that's something, of course, we can help you with as well. Tax loss harvesting, asset location, where you put the most tax efficient securities in your retirement accounts or your Roth account or your taxable account. Each particular, you should have sometimes different assets in each of those from its tax efficiency standpoint. But we also do other things like direct indexing, things that, you can get a more tax efficient exposure to the S&P 500, et cetera. So, if any of those things are interest to you, feel free to reach out to us as well.
Yeah, I actually did a calculation for my son who's 27 years old. He's contributing the max 7,000. He's like, it just doesn't seem like I'm going to get anywhere. So, well, you're 27. Let's say you retire at 65. I did the calculation and his eyes bugged out of his head, continuing to just do 7,000, not even considering that limit is likely to go up in the future. So it really, opened his eyes to what compounding growth can do.
So, Stacy, I think the last topic we wanted to talk about, a little bit different, but equally important, is maybe not every year, but periodically reviewing your beneficiary designations on your retirement plans, other designations that you make in your estate plan for trustee or executor,
Right.
those kinds of things. They don't tend to get looked at that often. And we have the routine experience where someone says, will you take a look at my estate plan? They send it to us and we look at it and we actually prepare a little outline of it and we go over with them. Oh, when you did this estate plan, your brother John, you named as a trustee, and usually either John isn't here anymore, John's a train wreck, whatever. These are very important designations that are going to control how your assets are distributed if something happens to you. So maybe give our listeners a process that you would follow, Stacy, to make sure they stay on top of these designations.
Right. It is hugely important to revisit what your wishes are. Back in 2000, my wishes are not going to be the same as they are now in 2025. So making sure that you review your beneficiaries on your retirement accounts or your insurance policies to ensure that that's still who you want to inherit those accounts. And with estate planning, not just beneficiaries listed within the contract or the trust, but you want to ensure that everything makes sense. I've seen so many 1998 trusts or 1996 or even 2002 trusts that have never been looked at since then. You get this nice binder, you put it on your shelf, looks so nice, and then it collects dust because you never look at it again. It's really important to update your trustees, your successor trustees. I've seen many times with clients that are, let's say, in their 80s or so, and they name a brother and he's 90. What's the likelihood he wants to even be a successor trustee? Or you have a situation where, let's say you're 40 years old and you name your dad. And then 20 years later, maybe your dad's not here anymore, like Peter said. So it's boring for most people to look through the estate plan. But that's what we're here for. I actually love looking through estate plans and finding, where should we adjust? So we can't adjust the plan or the trust, but we can give you an outline, like Peter said, to bring with you to your attorney's appointment to make sure that your estate is clean. I would recommend, every 2 years just to, scan through it, but really after 4 years, or if we've had a lot of policy changes that affect interest rates, that affect beneficiaries, that affect estate plan tax. So it really is important not to just stick your nice binder of your trust onto a shelf and forget it, because we want to make sure your wishes are still your wishes. I don't want to see people, and I have, unfortunately, have an old estate plan or IRA that had beneficiaries of their ex-wife, and they didn't change it. And all of a sudden now the person passes away and their ex-wife inherits $2 million. So really important to have your estate plan clean. This also applies to bank accounts. Many people have large sums of money in their bank. You don't want to have an individual account or just a joint tenant account without having what's called a TOD, a transfer on death. Many people forget about putting their savings account, their checking account in the name of a trust or adding a transfer on death. They just don't think of it. But if you think about it, let's say, I pass away and I have a ton of debt and I have, funeral arrangements, and my agent or my beneficiary needs to pay those bills, but they can't because it's going through probate. So probate's not a terrible thing, but it does, it's a public record, which I don't know about you, but I don't want my business being public record. And it can take a long time to go through the probate process. So rather than having anything in probate, we want to title all of our accounts the right way, whether that's in trust or transfer on death. We want to make sure all of our retirement accounts and insurance accounts have relevant beneficiaries on them. And when we want to update it or look at it after 4 years or 5 years, or when policy changes, we will go through the entire trust and power of attorneys to make sure they make sense still. I had the unfortunate pleasure of being named healthcare power of attorney for my dad. I didn't know that he did that. And I don't want to do that. So, when he got sick, I was faced with having to make decisions for him on the health side. So it's important for you to not just clean up your trust, but to have conversations with the people that are you're going to be passing the baton to in the event of sickness, in the event of death, in the event of incapacitation, to make sure that they want to take that role. It's not intuitive, right? Being a co-trustee or a successor trustee isn't necessarily intuitive when we're trying to distribute someone's estate. So you want to make sure to name the right person for that job. For me, healthcare power of attorney, I just didn't feel comfortable. So thankfully, my dad was, lucid enough where we changed it. So I became his durable power of attorney, and my twin sister became his healthcare power of attorney. So we don't want to talk to our kids, about our detailed estate, but you can at least put them in a position where they can understand what their duties are in the event of all these things happening. And if they don't want to do it, you need to find someone else. So having an estate clean is definitely a recommendation I have to all of my clients.
Very good. So want to thank both Stacy and Kyle for their insights. Just as a preview, our next month's Thrive Talk, Thresha, I think there's a slide here at the end that's a little preview of that. Jenna is going to host a conversation with Bradley Hajart from Next Level Catapult, where they'll talk about why companies have difficulty scaling and what they can do to scale better. So got 2 minutes left. If someone wants to lob in a question in the remaining 2 minutes, please go ahead. Otherwise, we appreciate everybody attending and thank our speakers for their fine comments.
I do see a question. What's the difference between a SEP IRA and a traditional IRA? That's a really good question. So a SEP IRA is employer contributions only. So you cannot yourself contribute to a SEP. If your company doesn't have a SEP IRA, you're not going to have a SEP IRA. A traditional IRA, anyone can have, as long as they have, you can have it. You just sometimes can't contribute to it if you're not working. But SEP IRA is only relevant if your company has a SEP IRA.
One question, Stacy, is around estate planning. Freedom Family Office, both companies are big into the estate planning space. And one question around, you mentioned you're transferring everything from debts to whatever's in the bank, whatever it could be. Now, question is, if someone's in a significant amount of debt, maybe from their business, does the person inheriting the estate take on all that debt?
Depends how the business is titled. Are there other owners? Are there, other entities involved? But you do take on that responsibility of all the debt of the person. So, I haven't had that situation, to be honest. But yeah, you take all the good and the bad.
So yeah, just say certainly some good tax planning. As long as your business is structured properly, you can keep it out of your estate, but you'd have to make sure that it's structured correctly.
Yes.
we
which a lot of
appreciate-
them are not.
Right. Appreciate everybody joining. Here's the preview for next month. You can register early by scanning on the QR code. Don't forget to get Kyle's book. And, please reach out individually to Kyle or Stacy in any of the topics they covered today. And hopefully we'll see you all on November 19th. Thanks very much.